company, CCL Products, an instant coffee manufacturer, has acquired 6 brands from Food Brands Group, a subsidiary of Lofberg's Group. This is in the UK. Now, this company expects the acquisition to boost its overseas footprint as it gives the coffee maker access to major supermarkets in the UK. To discuss this and more, we have the Managing Director, Challa Srishant, joining us on the show now. Srishant, thanks very much for being with us. Always good talking to you. So give us some more color on this, on these brands that you've acquired. By how much does it improve your prospects in the UK? Also give us some numbers if you can in terms of revenue, sizes of brands, etc.
So as of now, it's a 18 crore brand which is there in the UK. We were able to acquire this for about 5.5 crores. And our objective was that we wanted to replicate what we have done in India in the UK as well. So this is one of the test markets that we are working on. In India, we were able to go from 0 to about 150 crores within less than 5 years. And over here, we have a head start with this 18 crores acquisition. So we're hoping to achieve a 150 crore target in about 3 to 4 years.
Okay. Okay, got that. Also take us through, what is the distribution for this, like how many kind of supermarkets is it present in? Just trying to get a sense of, how much access you will get on behalf of acquiring this brand.
So one thing about the UK market is we already have access to almost all the major supermarkets because we are already supplying to them. So our objective was to leverage on our existing relationships to place our products in more number of supermarkets. Today, it's available only in 2 of the big chains, and our objective is to get it listed in all the other outlets as well. And we wanted to, again, invest behind the brand as well to make it grow bigger in a sustainable manner.
You mentioned, Srishant, that you see a revenue potential of 150 crores from these brands, right?
Yes, in the next couple of years.
In the next couple of years. So you're right now only factoring in, the UK market, or are you also perhaps considering them coming into India?
So initially our objective was UK market, but yes, we are considering launching this in India as well and some other parts of the world also. This is a brand that has been in existence from 1997, and we've been the manufacturer of this brand for several years. So we have received inquiries from our partners in different parts of the world to introduce this product in their respective countries. So that's one of the reasons why we were quite excited. We feel there's a good potential for this brand to grow much faster.
Okay. So a related question, will we see CCL Products get a little more aggressive in the B2C space? Would you be looking at more brands? Would you be looking at more revenue from direct retailing on the shelves versus, of course, all the sales that you're doing to the institutional segment?
Yes, so our primary vision is also to transition from a B2B to a B2C player. So that's one of the reasons that we have started with this acquisition. And our intention is to keep a lookout for similar such opportunities. One good thing is that because we've been in the market for more than 28 years, we have access to almost every market. We know what brands are doing well and what can be revived. Where there's an opportunity, we'll be there.
Okay. Got that. Just one question on this, on the new brands that you have acquired. Can you take us through what kind of margins these operate at right now, and what is it that you expect as well?
So as of now, it's a brand that is EBIT positive. It's only about 2% or 3% EBITDA positive right now. And going forward, once we start manufacturing our own products, we feel that the margins will definitely improve. Right now, the current the previous brand owner used to buy the product from another third party. So once we start supplying, the margins will also improve. We believe that we can grow this brand with in a sustainable manner for the next couple of years with a minimum investment going forward as well.
Okay. Srishant, so to also sort of club that with the point that you just made earlier, since B2C is going to be a big focus for the company now, if I look at your top line, you did a top line of around 1,700 crores in FY23. What was the mix between institutional segment and retail? What will the targeted mix be, say, this year going into next year? And as you shift towards the B2C segment, what does that mean for your margin profile? The numbers here tell me that I think blended margins were at around the 17% handle. So as you come towards the retail side, does it go up?
Yeah, so actually we've done about 2,070 crores for last financial year, and about 250 crores was the domestic business that we have done last year. Out of that, again, about 150 crores was the pure play branded business. So branded business also, we've actually broken even about 2 years ago, and we are intending to grow that in a more sustainable manner. Our primary focus for the next couple of years is to focus on the top line growth. We're not really looking at focusing on the bottom line growth. We wanted to keep reinvesting in growing the brand faster.
And what's the targeted margin range? Again, if you could just give us a mix. I mean, your branded consumer retail segment versus the traditional segment, what will be the revenue mix? And what's the margin range you're looking at this year?
So if you look at revenue mix right now, it's about 6-7%. And going forward, in the next couple of years, we are hoping it will cross 10 to 15%. And as far as the bottom line is concerned, the branded business has the potential of getting EBITDA margins about at least 5-6% more than our core business, which is B2B. And because it's a brand, I'm talking about after all expenditure and all that, getting at least about a 5-6% higher EBITDA percentage.
Okay, got that. Just want to ask you about the small packs unit as well, because I believe you have completed commissioning of that. So can you take us through what volumes on that will look like? And then, of course, this is a margin accretive business. So what could the margins be once, the volumes scale up?
So as of now, we have built a facility that can cater to about 25,000 tons. We have a current capacity of about 13,500 tons, and we can just add a couple of machines in the unit, and we can expand the capacity to 25,000 tons. And as far as margins are concerned, we are looking at a slight improvement in margins going forward as our volumes increase as well. Today, with the green coffee prices at an all-time high, it appears as if our EBITDA margins have come down, but actually our per kg margins are still intact.
Okay. Your small packs volume share was at 20%, right?
Yes, it was at 20%.
So can you tell us what you expect on that with this higher, with this, you said you could add a couple of machines and move that up. What is the timeline for that?
So we can, in the next 2 to 3 years, we're looking at making it go up to around 35%. And the 35% I'm referring to after we have doubled our capacities. Okay. So it's going to be a significant increase.
Okay, got that. Srishant, we leave it at that. Thank you very much for joining us and taking out the time to speak to us about this new acquisition and what it could really do for your business. That is the management of CCL Products. The stock is holding up well today. It is moved and it is currently over 1% in the green right now. We are going to get